until investors are comfortable and confident that inflation's been tackled and inflation's coming down, we're going to see higher than we want mortgage rates. And so I think that's going to be a big driver of what happens in 2025. And if we don't see inflation come down and we don't see mortgage rates come down, I think it could be another tough year.
Welcome in, tribe. This is our friend Jay Scott back for a second time on the show. Jay, so glad to have you, man.
I'm thrilled to be back. Thanks for having me back, guys.
Jay, there's a consensus out there that there's opportunities, there's deals in the marketplace, but they don't see a lot of those being done. As we start off this conversation, I'd love to get your opinion on why that is.
Yeah, I think the biggest reason is that there's so much uncertainty out there. Nobody really has any idea where the market is headed, where rates are headed. There are a lot of sellers right now that are still in wait and see mode. I know 2 years ago, I'm in the multifamily space, and a couple of years ago in the multifamily space, as interest rates started to rise, we saw a lot of sellers who kind of pulled back and they said, hey, my property's not worth what it was yesterday, so I'm not going to take a big discount. I'm going to wait for rates to come down. I'm going to wait for cap rates to come down. And then I'll sell when my property's worth what it was in 2021. Unfortunately, over the last 2.5 years, we haven't seen values come back. I mean, the nice thing is we haven't seen values drop much in the last 2 years. We saw basically a quick drop of 20-25% in the multifamily space between March of 2022 and September of 2022. So we saw a quick drop as soon as interest rates started to go up. We saw cap rates expand. We saw NOIs start to slow down or at least stagnate. And so we kind of thought, okay, are we going to see a much bigger downturn, or is this the end of it? And it looked like that was the end of it, but we haven't recovered. And so for the last 2 years or so, we've kind of been sitting on the bottom in multifamily, mostly because rates haven't come down, mortgage rates haven't come down, and cap rates haven't started to compress yet. And so a lot of sellers are sitting around thinking, I still want my 2021 prices before I sell. I still remember how much my property was worth. I'm not ready to sell for a discount yet. Buyers, on the other hand, are looking around saying, hey, things aren't worth what they were in 2021. I'm not willing to pay that. And so we kind of have the stalemate between buyers and sellers. And what we've seen over the last 2 years is very, very little transaction volume. Very few things are selling. And so there are some great deals out there, mostly because there are some sellers who are running into roadblocks on their debt. A lot of sellers who back in 2020, 2021, even beginning of 2022, took out these 3 and 5 year bridge loans. And now these loans are coming due. And in some cases, the sellers are working out with their lenders and saying, hey, give me an extension. Let's extend this until the market improves. But in some cases, the lenders are tired of giving extensions or don't want to negotiate. And those sellers are now in a position where they either need to bring money to the table to refi, or they need to dump the property because otherwise they're going to get foreclosed on. And so if you can find those sellers that are in a tough position based on the debt that they have, there are some great opportunities out there. And I think we'll see more of those over the next 6 to 12 months.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stanley, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before. Go to what'swhatwallstreet.com/PIOS.
You've got to find those opportunities where someone basically is hurting, right? There's not a lot of people selling because they want to. They're selling because they have to. If you're not buying in multifamily, where are you looking to invest capital? I know that the last time you were on the show, you talked about getting a lot of equity in deals using experience that you had from the tech space. Yep. Are you seeing success in other areas outside of multifamily? And if not, why?
So a couple of answers to that question. First, we are still investing in multifamily. We're just not doing it the traditional way of investing in what's called common equity, which is being a regular investor in multifamily deals. What we're doing is we've created a fund. It's called a preferred equity fund, and preferred equity is kind of some hybrid between debt and equity. It looks a lot like a loan for the deals that we're doing, as opposed to regular equity investments. And so what we're doing is we're going into deals, other people's deals, we're bringing capital, and we're providing them capital in a way that resembles debt. It's lower cost to the operator, lower risk to us. So our investors get lower returns, but they also have lower risk, which is what our investors want these days. Investors are concerned about the market. They're seeing a lot of deals go belly up. They're seeing a lot of deals that aren't hitting their pro formas from a couple years ago. They still want to have their capital working, but they don't want to invest in the traditional sense because they just don't know what the next year or two or three is going to bring. And so we've created this preferred equity fund that allows investors to continue to invest, lower risk, slightly lower returns, and kind of provides the best of both worlds and also allows us to keep moving forward. So we are still investing in multifamily in that sense. Outside of multifamily, we do some angel investing. So we invest in the tech space. I do some advisory work in the tech space. We're still doing a little of that, but I'll be honest, we've seen the same issues in the tech space that we've seen in the real estate space, which is there are capital issues. It's difficult for a lot of these tech companies, especially these smaller tech companies, to attract capital. And just like in the real estate space, where you need to refi every few years, in the tech space, you're generally raising venture capital every few years. And capital is pretty tight right now. So there are a lot of companies that raised capital 2 or 3 years ago. They're running out of money because they run at a loss. They're ready to raise capital again, but they can't find anybody to provide that capital. And so now they have to either fire sale the company or they have to figure out some other solution. So it's not just a real estate issue. We're also seeing this in the business space as well.
Well, you mentioned the symptoms are that people are uncertain, right? Well, what's the result is that credit gets tight, the capital gets tight. So I want to go back to the issue or the point that you pivoted from doing your own deals to putting money in other people's deals that maybe are having the good luck of finding those deals that are maybe distressed or what have you. And you're choosing to then go in as when you say what you say, I think mezzanine debt, which is kind of behind the first lender, the primary lender, you're like that second lien, but you're saying it's not a loan, it's equity. So talk to me about that. Do you have the ability to foreclose as if you were a lender, or is it just an equity position? How is that different?
Yeah. So the analogy to mezzanine debt is actually a good analogy. It's very similar to mezzanine debt. In fact, if it were up to us, we probably would be doing a mezzanine debt investment. But typically when you're an operator and you find a big lender to give you a loan like a Fannie Mae or a Freddie Mac or any big bank, what they say is, we don't want any other lenders in the deal. So you can't have a mezzanine lender. So that kind of precludes us for going in and offering mezzanine debt. So what we do is we provide this thing that's very similar to mezzanine debt. It's called preferred equity, but it's actually an equity investment instead of a debt investment. So the big differences are, as you mentioned, Joey, we can't foreclose. We don't have the ability to take back the project if they stop paying. But what we do have the ability to do is we write into our contracts that if the deal stops paying us every month, the same way they pay their lender, if they stop paying us while we can't foreclose, what we can do is we can take over management, or we have more votes in the GP. We're actually part of the general partnership. And so we can take over asset management or have more say in the operations of the deal. And so it gives us additional control as well as a better position in the capital stack.
Jay, I know you guys are experts in operating your own deals and have in the past and now are pivoting a little bit, but I want to answer the question for the person that has been recently burned investing through sponsors and not through operators. And so how do you guys avoid, or how do you answer your investors' questions when they're like, how much do you really know about what's going on at the operational level if all you are is a preferred equity and you're just the investor into the operator and not the operator themselves?
Yeah, and it can be a tough question to answer in a way that you can really reassure your investors. The honest answer is we do take a very direct role in day-to-day operations. We sit in on weekly meetings. In fact, one of the requirements we have for any deals we invest in is that there's a weekly meeting with the asset management team and the property management team. So we always know what's going on. We have access to the financials. We basically know what's going on in the deal as if we were running it, even though we're not running it. And we have a literal GP position in the deal. We have equity in the deal. We're listed as part of the management group. We're listed as part of the syndication general partnership. So from both a legal and technical standpoint, we're part of the deal. But also just from a tactical standpoint, we're going to be involved in the deal at least on a weekly basis. And so that provides some comfort to our investors. Additionally, and we tell this to our investors, we generally want to invest with operators or with in deals where we know the operator, where we trust the operator, where we've worked with the operator before. And if you look at the deals we've done in the past, it's with operators that we've partnered with in the past. It's with a couple big names in the industry that our investors have probably heard of outside of us, so they can vet those operators independent of just taking our word for it. So we're very careful about the deals that we go into. So we try and mitigate risk in several ways. One is investing lower on the capital stack, but the other is really having some operational control and really knowing and vetting who our operators that we partner with are.
No, that's a good answer. And I appreciate this. I mean, obviously we have seasoned investors. When you say NOI and cap rate and stuff like that, they're like tracking right with you. And then we have the person that just found out about What's Wild Wall Street yesterday. Yep. Their buddy has been building passive income, and they've been trying to figure out what that even means. And they had to get on ChatGPT and Google it. But they're trying to figure out what that actually means. And so I also want to inform those investors who are learning how to become a better investor. What do you have to do? Like, how do you vet the people that you're investing in? And it's asking you questions just like this and listening for what your response is. Are these people that have done it for years and years? Do you have a very strict criteria in which you're not going to invest into an operator unless they have been in the industry 10 years, 15 years, 20 years? Because to be honest, like over the last 10 years, everybody's made money. I mean, unless you were a real idiot, you made money in the last 10 years investing in the multifamily space. It's up into the last couple of years where the warts are starting to show up, right? We're starting to see like, oh, maybe not everybody was the genius we expected. So it's asking these kind of questions to help us learn how to be a better investor. You obviously are tracking the economy. You're trying to figure out where the puck's going so that you can make these investments. And you're being asked to speak on this a lot. Give us what your prediction is for 2025. You're the Nostradamus of multifamily investing right now. I'm going to give you the floor. You got your crystal ball out. Talk to us a little about some of the economic landscape and how it's going to affect the things that we all are investing in.
Yeah, so I certainly don't have a crystal ball. So I hope nobody listens to this and assumes I know what I'm talking about. I think the problem is that we hear so much information from economists and other pundits that we assume they know what they're talking about. We're all making educated guesses based off the data, based on things we've seen in history. And so I'm happy to make my educated guesses, but please don't anybody put money on anything based on what I'm about to say, because a lot of us, even some very knowledgeable and experienced economists, have been wrong the past few years. But I think the big question everybody's asking about 2025 is, where are rates headed and where's inflation headed? And those two things are intricately entwined. So we have this thing called interest rates. Interest rates kind of define how much we can borrow money at. And as investors, we like lower interest rates. We want to be able to borrow money from banks at lower rates so that our monthly payments on our properties is lower. And so our rate's going to go down in 2025. Well, a year ago, it looked like we were heading in that direction. The Federal Reserve said, hey, we're ready to start lowering interest rates. Inflation's under control. Once we lower interest rates, we expect mortgage rates to come down. The incoming administration has basically said, I'm going to bring down interest rates and I'm going to bring down mortgage rates and we're going to get back to 3% interest rates. But the reality is that's probably not going to happen. And the reason that's not going to happen is because while inflation has come down tremendously over the last 2 years, it's basically stalled out. And so we have inflation that is under control, but not down as far as where we want it to be. And the Federal Reserve ultimately is going to make their interest rate decisions based on inflation. If inflation's too high, the interest rates need to stay higher to keep inflation under control. And so as long as we have inflation, as long as we have more inflation than we want, which is what we still do, interest rates are going to stay higher. And then mortgage rates don't always flow from regular Fed interest rates. Sometimes mortgage rates can go up, even if the Federal Reserve is saying we're lowering our interest rate. Mortgage rates are supply and demand, and mortgage rates are very much an indicator of where investors think inflation's headed over the next 10 years. If you see mortgage rates going up like we have over the last couple of months, we've seen mortgage rates go from 6.2, 6.3% for the 30-year to now over 7%. That's an indication that investors believe we're going to have inflation over the next 5 to 10 years, because there's a direct correlation between investors' expectations for inflation and mortgage rates. And so until investors are comfortable and confident that inflation's been tackled and inflation's coming down, we're going to see higher than we want mortgage rates. And so I think that's going to be a big driver of what happens in 2025. And if we don't see inflation come down and we don't see mortgage rates come down, I think it could be another tough year. I'm not saying there won't be great deals out there. Like we talked about earlier, there are going to be some great deals out there, but it's not going to be like a boom year like everybody was hoping when we thought interest rates were getting ready to drop like a stone.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
Tribe, if you're still searching for what is going to be that passive income source that's going to push you over the hump, it's going to help you become financially free, head over to the Art of Passive Income podcast, where our friend Mark Podolsky breaks down his amazing land flipping method.
You've heard us talk about how this one strategy has created over $30,000 a month in passive income for Russ and I. Do yourself a favor, wherever you listen to podcasts, go hit the subscribe button to the Art of Passive Income podcast today.
Jay, thank you for giving us some insights there. But I want to take this and connect it back to what you said. Hey, we've pivoted from doing our own deals to going into a quasi-debt relationship in other people's deals.
Yep.
Now you're saying, hey, inflation is still on the rise. Like we're still going to see that, or at least that's what the income or the interest rates indicate, is that people think that will happen. So is the investor that's listening to you right now to kind of reset expectations that maybe the yield that they're used to getting on deals needs to be maybe lower in their mind? Like they need to be okay with a little bit lower yield to be in more of a secure position, rather than maybe some of the deals that they were used to are more risky than they really thought they were to begin with?
Yeah, it's a great question. I think the first thing that's worth reiterating, and a lot of people understand this, and a lot of people think they understand it, but they don't think about it enough, is that risk and return are intimately related. You don't get higher returns without higher risk in what's called an efficient market. In a market that's operating well and has a lot of deals taking place, you don't get higher returns without higher risk. If you want to make 100% returns, you can do that. You can go to a casino and put money on red or black, and you can make 100% returns potentially, but there's a lot of risk involved with that. If you want super low risk returns, you can get that. You can buy treasury bonds and make 4%. Most people are happy somewhere between that 4% and that 100%. And depending on where you want to fall, if you want to fall at 10%, you're going to have less risk than if you want 15% or 20% or 25%. And so the first thing I recommend to investors is when you're looking at a deal, look at the returns that deal is offering. If that deal is offering higher returns than other similar deals that you've seen, it's probably a riskier deal. Because why, as an operator, would I say, Joey, Russ, I'm going to give you 20% returns if I could offer you that deal and get 15% returns? The only reason I'm offering you 20% is because I know you're not going to invest with me if I only offer you 15. So why aren't you going to invest with me at 15? Because you need 20 because you think it's a higher risk deal. And so first question you need to ask is, what are the returns? Compare those returns to other similar deals. If it's higher, it's probably a riskier deal. If it's lower, it's probably a lower risk deal. And that's why when you go into let's say I'll use multifamily as an example. If I go into a multifamily deal and I'm buying a stabilized property, I'm buying a property that, let's say, was built in the last 10 years, it's been completely renovated, all the units are leased up at market rates. What's that property returning? It's probably returning whatever the quote unquote cap rate is in the market. It's probably returning 7%, 8%, 9%. If I then go and buy a value add property, and a value add property is one where I'm buying an existing property, but it needs to be renovated. It needs some TLC. It needs some painting done. It needs some cabinets replaced. All of those things. There's a little bit more risk in that deal because I have to do renovations and I'm probably not fully leased up, and things that are leased are probably below market. So if I do a deal like that, I can probably offer my investors 12, 13, 14% returns. It's a higher risk deal. They're going to get higher returns. Now imagine a deal where I'm going to go buy a piece of land and I'm going to build and I'm going to do new construction. I'm going to build a 300 unit property. There's even more risk in building new construction because a lot of things can go wrong. The market can change in the 2 years between now and then. I could get my assumptions wrong. The cost of labor and materials can go up. Lots of risk with new construction. So if I'm going to do a new construction project, I'm probably going to have to offer my investors 20, 21, 22% returns in today's market. And so as you see, different types of deals, different levels of risk, different levels of return. So always be asking the question, what is the level of return? How does that correlate to risk? And how does that compare to other similar deals? If it's a higher risk deal, or if it's a higher return deal than others that are similar, it's probably more risky. If it's a lower return deal than others that are similar, it's probably a less risky deal.
You've got a friend that comes to you and says, "Hey, Jay, man, I've watched you from afar for years and years being this real estate investor, and I'm ashamed to say I've done nothing up to this point, but just just stalking you from afar on Instagram or Facebook or podcast episodes or whatever." How many deals would you tell that friend of yours to go look at to have a good feel of what the market rate is, right? Because you just gave a great example of like different levels of risk. But what my previous experience is for most people, they see two deals do one.
Yep.
So you're talking to your friend, how many deals do they need to see before doing one?
Yeah, and it's a tough question, but they certainly need to be able to watch an investor presentation or read an investor deck and know exactly what's going on, know what questions to ask, know what to expect. If you still read an investor presentation and don't understand half of it, you're not ready to invest. And there are a lot of great resources out there. Luckily, let me give a plug for a book by a friend of mine. Brian Burke wrote a book called The Hands-Off Investor, and published by Bigger Pockets, probably the best book on the topic, but it's basically an in-depth guide to how to invest passively in syndications, how syndications work, the questions you need to ask the sponsors, et cetera. So Hands-Off Investor by Brian Burke is a great resource. Start with that. But then, go start listening in on investor presentations. I tell my investors all the time, or my potential investors all the time, I don't care if you're not ready to invest today. If you're not accredited and you can't invest with me, or you're not ready to invest for another year or 2 or 5, great. Come sit in on my presentations. Sit in on 2 presentations or 5 presentations or 10 presentations. Don't invest until you're comfortable, because let me tell you something. As a sponsor myself, as an operator myself, I don't want to take money from somebody who is not comfortable investing, because they're going to be, for lack of a better term, a pain in the butt after the deal's done. They're not going to sleep well at night, so they're going to be blowing up my phone or my email, or they're going to want to do a Zoom call and talk about the deal and what's going on, and every little thing that goes wrong, they're going to be concerned about. I don't want my investors to have to stress like that, because that causes stress in my life. I want my investors to be comfortable. And so what I tell my investors is, go watch 10 or 20 presentations from lots of different sponsors, lots of different operators. And maybe you'll be comfortable after watching 2 or 3 of those. Maybe it'll take 10 or 20. Everybody's going to be different. But make sure you know what you're watching and what you're listening to, and make sure that you have a good understanding, or you think you have a good understanding of what you're reading when you're looking at a deal.
Super great advice, Jay, for sure, especially for somebody who's just starting in the game. Being educated is the work of being a passive investor, right? People think passive investing, it's just hands off. You don't do anything. But if you haven't done the pre-work, you then you'd really have not done the work.
I like to say that in a typical investment, an active investment, you are doing work from the beginning to the end. In a passive investment, you're doing just as much work, but it's all up front. And you have to do a lot of work because the day you turn over your capital, the day you sign those documents, you now have no more decision-making authority. You have no more impact or control over the deal.
Right.
All of your control, all of your decision-making authority is that 1 week or 2 weeks or 3 or 4 weeks between the time you start looking at the deal and the time you invest. And so you need to be willing to put in a lot of work. There's no such thing as a passive investment, only passive after you investment.
Right. And so I really want to take this to a really tangible, practical thing. So we can pontificate about all the possibilities of what 2025 brings. But as you have taken in all that data, I'm just going to truncate the conversation and say, what is J. Scott most interested in investing in for 2025?
Yeah, so I'm still a huge fan of multifamily. I decided to get into multifamily about 6 or 7 years ago because it's, for me, the best asset class on the planet. It has the best risk-adjusted returns, meaning it has the best returns given the risk in the market. Historically, it's been one of the most consistent asset classes out there. I love residential real estate because it's one of those things that you never have to worry about it going out of favor. People are never going to decide, I don't need a place to live. In terms of the current market, I think we're seeing home ownership rates likely to go down over the next couple of years simply because sentiment is changing about owning homes. Obviously, home affordability is at an all-time low. So I think a lot of people are going to need a place to rent. I think we're likely to see inflation over the next couple of years, and inflation tends to drive up rents. I think now in general, or now specifically, is a great time to invest in multifamily. But in general, I think multifamily is one of the best investment asset classes out there. So while we've had a couple rough years, every asset class is going to go through cycles. You're going to have a couple of rough years. I'm hopeful that we're near or at the bottom. And so anything we buy this year or next year, if we have the ability to hold on to it for 5 or 10 years, it's going to go up in value tremendously over that time.
All right, so I'm gonna ask you to say, okay, that's where your knowledge is, and that's probably where you should invest. Joey and I are not huge real estate investors, right? That's just the things that haven't interested us. One, because it's just not our investor DNA. So we talk a lot about, invest in the things that you're passionate in, because then you'll invest more money. The things that you're not passionate in, regardless if they work or not, you don't invest as much. So you don't end up getting the results that you want. So talk to Joey and I. We're not real estate investors. If you're going to invest somewhere else outside of multifamily, based upon maybe personal investments that you have on the side, relationships you have with people that are doing things and having success, what would be that asset class that you would pick for 2025?
Yeah, and I'm happy to answer that question. But before I do, let me just say what I'm about to say is very personal. And if I give advice to somebody else about what they should invest in, it may be different than what I'm going to invest in, because the thing I'm going to be most comfortable investing in is the thing that I understand the best. Because remember, we just talked about the fact that with a passive investment, once you turn over the money, you have no control anymore. You need to make good decisions, and you're going to make better decisions in assets and asset classes that you're familiar with. For me, it's technology. So I come from the tech world. I spent a decade in Silicon Valley. I worked for companies like Microsoft and eBay doing tech stuff. I do a lot of advisory work in the tech world. So for me, I can vet, I can underwrite, I can evaluate a tech deal, a tech business investment better than I can evaluate investing in a restaurant, or better than I can evaluate investing in a hedge fund, or better than I can evaluate investing in a self-storage or an industrial deal, because that's an area that I know, and I can look at a deal and say, I know the right questions to ask. I know the things to look out for. I know the good signals and the bad signals. Those are the things I'm going to be most comfortable investing in.
No, that's good. And I'm so grateful that you answered that way, by the way. It just reaffirms everything we keep saying. Don't invest in something because someone else said it. I was hoping you were going to say that, but again, that's a kind of an insider joke here on our end to test our our experts to see if they will stick to that, because we want to have everyone investing from their sphere of expertise, not from just because somebody else is having success in it, they should do it too.
Well, I tell the same thing to my investors, by the way. I mean, if I have an investor that's historically invested in self-storage or mobile home parks or RV parks and says to me, hey, I want to get into multifamily investing, my first question is why? If the answer is diversification, great. I'll let's talk. But if the answer is, well, I think the grass might be greener over in multifamily, my answer is going to be, well, if you really know self-storage, if you really know RV parks, if you really know mobile home parks, whatever it is, you're going to be able to vet those deals a whole lot better than you're going to be able to vet multifamily deals. And so stick with that thing that you know. Again, diversification is a great reason to switch asset classes. But the grass is greener sort of thing, that's not worth it, because you spend a lot of time learning an asset class and learning how to vet deals. It's not worth it to give all that up just to do something different.
Yeah, I agree. Jay, if people wanted to get in touch with you, follow you, where would you send them?
jscott.com, letter J, SCOTT.com, and that will link you out to everything you need.
All right. Well, Jay, great to have you back. I know it's been three years plus since you were here last time. Hopefully we can get you back before then, but thanks again for dropping knowledge. I'm grateful to have you here.
Love it. Thanks, guys.
All right. Thank you, Tribe, for listening. Found value. Take time to rate and review the show. Share it with somebody that needs to hear it. Go to jscott.com if you want to follow Jay and what he's up to. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.